Hey guys, I'm here today with Sarry Ibrahim of finassetprotection.com, and we want to talk to you about a specific type of financing vehicle and really just overall financial vehicle called a bank on yourself policy or bank on yourself program. And what really attracted me to having Siri on the podcast here today is that, this is something that I've actually been using for about the last 11 years since I got my first policy, I think it was. And it's something that a financial advisor that I know that I was friends with got me turned on to back in my early to mid 20s. And I've built out a portfolio now of these policies, and I've used them myself for different types of investing and real estate and all the different benefits that they have that Siri will be talking to everyone about today. So, Siri, appreciate your time. Thanks for joining me.
Hey, Rob, thanks for having me on.
Absolutely. So the first question is, I know most of our viewers and listeners, they've never heard of a bank on yourself policy. They don't really know what it is. Can you just kind of give a bird's eye view in layman's terms of what a bank on yourself policy is?
Yeah, definitely. So a bank on yourself policy is it's a type of whole life insurance. And the whole life insurance policy, for those of you who are not familiar, has two main functions or two main purposes. One purpose is the death benefit. That's if, based on the contract, if you die, your beneficiary would get X amount of dollars. And then the other function, which is the bank on yourself concept, what the bank on yourself concept focuses on is the cash value of the whole life insurance policy. It's kind of like a savings account in a whole life policy, except this cash works a little bit different. It's actually treated differently from other places you would store your cash. And it has a lot of extra benefits and purposes, such as taxes. The growth of the cash value grows tax deferred. In a lot of situations, the withdrawals and loans are tax free because you're using after tax dollars. The cash value in the life insurance policy is also, from an asset protection standpoint, it's also protected from creditors and predators, depending on the state you live in. So that's another strategy or a reason why people use whole life insurance. Also, safe money. It's not invested directly into the stock market, so you never feel the twists and the turns of the stock market. The companies we represent have been paying dividends towards the cash value of these policies for over 160 years. So you can always see an increase of the cash value of the life policy throughout the years, regardless of market trends and market conditions. There are no contribution limits with the policy, and liquidity and control is also really important. You can access about 85 to 90% of the cash value at any time. No underwriting involved. You just fill out a form, send it to the insurance company. They send you 85 to 90% of your cash value, or however much you want or need. And then, of course, integration, and I could touch more on that. Do you have any questions you want me to stop and talk about?
No, I think that there's two things that I wanted to just mention at this stage. When, you put something on the screen that says whole life, and I want to just, get the cat out of the bag here, because a lot of people are going to see whole life and they're going to be like, whoa, wait, I was told that was a bad thing. I was told this isn't good. I listened to Dave Ramsey or Susie Orman. They said that I shouldn't buy whole life, and this is a bad type of insurance policy. So I want to just put that to rest right now, because I've heard all that. Again, I've been doing this myself for over a decade. And, I want to let everyone listening and watching know that all the financial gurus, all the stuff you read online, all of that about whole life, I'm not going to say it's wrong, but it's not about this type of policy. This is a customized whole life policy that is made for a specific purpose of personal banking or family banking. There's a lot of different strategies that can be used with it, but it's customized to your needs. When you hear or read the stuff on the internet about whole life being bad, they're talking about the old school whole life policies that were sold, many years and decades ago, and they were peddled to people, using unrealistic assumptions. Unfortunately, they were given incorrect information. They were not customized to maximize cash value. Okay, they were customized to maximize the commission of the salesperson, and that's where they really got a bad name. Now you go back really over the last decade or couple of decades, because these have been around over 100 years, by the way. These are not new policies. I mean, this is something that has been around since before the Great Depression. But with that being said, you have to disconnect yourself from what you may know or think you know about life insurance in general and whole life insurance, because what we're talking about is a completely different strategy. It's a completely different type of use for these. And if you don't have that paradigm shift and you don't have that open mind, then what we're talking about is not going to make sense to you. So you really want to disconnect yourself from what you think you know or what you may have read or heard or seen about this before, and realize that this is a different approach to the entire topic of life insurance and family banking and specifically whole life insurance. So that was the first thing I just wanted to get out there so that people don't think that we're just going down the same path and that they might know or think they know what we're talking about. The other thing is just to throw in, my use of this is, and Sarry will talk about a couple different case studies, but I just want to let you guys know up front what I've accomplished with this. Number one is I paid my home off using a bank on yourself policy. Okay, so I have no mortgage on my home now because of this. This is something that I was just able to do really in just the last couple months. So I've been fortunate that I've been able to now capitalize this bank on yourself stuff for over a decade, like I said, and I'm proof positive that it works because I paid my house off using it. That's number one. Then the second thing is I actually bought a commercial building a couple of years ago using a bank on yourself policy, because I do have several, like I said, and I was treated as a cash buyer. I made a phone call to my insurance company and I got a check and I was able to buy that outright in cash using a bank on yourself policy. So I've used this myself for a lot of other things, but I'm just giving you the two real estate related things that I've done, and we can talk more about it in Sarry will show some case studies, that this can be used as literally be your own bank. It's called bank on yourself for a reason. And hopefully that just entices you. It gives you a little bit of meat as to why this is so important, why we're talking about this. And it's not something you're going to hear on a lot of other podcasts. You're not going to learn about this on a lot of other YouTube channels or other content you may see on the internet, because it's not mainstream. This is something that the wealthy or the people that are thinking like the wealthy are using. This is not something that, random person that, makes 20 grand a year and is paycheck to paycheck and is trying to buy their first home. This may not be the best strategy for them. And I'm sure you can talk about who this is appropriate for and who it's not appropriate for. But I just wanted to give the viewers and listeners just a little bit of my background, my story with this, and why I was so excited about having you on here. So if you can kind of use that to parlay now into how can this be used for first-time home buyers? How can people use these policies for real estate investing?
Yeah, definitely. Yeah, thank you for explaining that. That was actually a really good explanation of whole life insurance and its benefits. One of the things I wanted to really touch on right here, integration. This is what I mean by integration is, as you said, you can use this for numerous functions, numerous things at the same time. You can connect this with your real estate business, your other business, your personal home, and kind of create your own banking system where you can capture all the interest. And you can see right here, I know it's kind of sloppy, but let's say, for example, on the far right, we have a deal, right? We come across a deal that requires a $50,000 investment. There's a couple ways you can fund this. You can borrow from a lender. You can go through a private money lender. You can use your own cash. But the bank on yourself way is better to use your own bank on yourself policy. And I'll explain why. So you see right here, Rob, how we have $100,000 in cash value in the policy. I'm going to use my policy to pay for this $50,000 deal, but I'm not going to subtract $50,000 from my cash value. I'm going to borrow that from the insurance company, use the insurance company's money, pay for that deal, the $50,000 deal, and my $100,000 cash value continues to grow and continues to earn interest as if I never touched it, as if I never touched the money. That's why I would prefer to use this over cash or using other, if I'm able to use other, than to use other people's money. And to give you a better idea of the simple interest, here's kind of a breakdown of simple interest. If we took out a loan of $1,200 in month 1 and then paid it down by month 12, we'd end up paying $27 in interest or 2.3%. So we can kind of use these same figures for the $50,000 loan. It'd be proportional because a lot of insurance companies, their interest rate is about the same, 5%. So with the $50,000 example, we'd end up paying like $53,000 over the course of 5 years. And then you might ask, well, why did I just pay an extra $3,000 to the insurance company when I had the $50,000 in cash? And the reason why is because, again, while you were using the insurance company's money, the insurance company was paying you dividends and interest on your money as if you never touched it. Here's an
So
idea.
doesn't it end up being like a zero interest really when you figure, okay, I'm paying 5%, but I'm earning 5% on the money? Isn't that like a net zero, or isn't that what the idea is that there's a lot less interest by doing it this way versus borrowing from a bank or another institution?
So you actually come up ahead. So there's an arbitrage. You make more from the insurance company than you would spend on interest. And you can see right here in the example that we just did with $100,000. So the first line is the year you start the policy. So year one policy, let's just say this person is 35 years old. They put 12,000 in every year. Their death benefit is 441,000, and their immediate cash value for the year is $7,000 for the first year. And then every year they're putting in 12,000. It's continuing to grow. Now, for the example that we just did with $100,000 in cash value, we'd have to pretty much be around between between eight and nine, right in the middle right here, for us to have $100,000 in cash value. And let's say that we borrowed 50,000. We paid it back over the course of 5 years. After 5 years, we jump down to year 14 now, would have $202,000 in cash value. But we also had to pay the premium too. We can't ignore that, right, Rob? We had to pay the premium during this whole time. So we spent about 60,000 in 5 years over the premium. And we have a difference now of, let's see, let me just do this math. Oh, sorry. Are you following me so far?
Yeah, no, I'm definitely following. I mean, that's one of the things I love about this is that it can be a foundation for you financially because the value goes up every year. So like he was saying earlier, you don't have to worry about the stock market volatility. You don't have to worry about the economic volatility. You know that contractually guaranteed the policy cash value is going to increase every single year. So it can give you a little bit of certainty. So you can do higher risk investments in real estate. You can do maybe some higher risk investments in stocks and things, knowing that I've got this cornerstone. That's why I set this up in my early 20s, because I didn't know what was going to happen. And I figured, let me just get this in play now. Let me put this there so I know guaranteed I'm going to have a nice retirement, because I'm also using mine as a retirement vehicle, which you can talk about because it can be used as a pension and as a way to earn income in retirement or receive, guaranteed income in retirement. So I figured, let me set this up now. Let me get this put in play and let me make sure that I don't have to worry about the stocks going up and down. So by doing that, it's my cornerstone of my entire financial plan, which then allows me to swing for the fences on real estate deals because I've got this super low risk, super conservative thing going on. So I can be really high risk in my stock portfolio. I can be really high risk in my real estate portfolio. Because even if I lose huge amounts of value and money there, my cornerstone is good. My cornerstone is fine. During this coronavirus pandemic, the stocks are all over the place. My whole life policy is staying intact. My whole life policy is actually going up when the stock market's going down. So I just wanted to point that out for everyone. So there's so many uses of this, as we'll talk about. If you set it up right and you really buy into the vision of what this is and what it can be for you and your family, this can literally be a Swiss Army knife of finances. That's how it was explained to me, is that a whole life properly structured policy is like a Swiss Army knife of finances because it's got like 20 different tools. You open up the whole life policy and you've got all these different tools that you can use from it for all these different reasons. Okay, so hopefully, again, that keeps everyone motivated here to kind of see through all these examples and see that we're talking about 1 or 2 or 3 ideas, but there's really like 20 different ideas that all play in with the same thing.
Exactly, yeah. So let's say with this example right here, with this illustration, I don't have to decide, should I save for my retirement? Should I save for a short-term goal? Should I save for a long-term goal? Should I invest in real estate? I could do all of those things together. I can connect them, integrate them all together and build my retirement, 30 years from now, 40 years from now, while also taking advantage of cash real estate deals, while taking advantage of short-term business moves. I could do all those things together. And I think that's really important. It's not an either or product. It's a both and product. And for new homeowners, new homeowners can use these policies for a couple different ways. One way they could use them is they can save up the cash in the whole life policy and then use the cash as a down payment. They can finance their own down payment and then pay themselves back and then, still earn interest and dividends on their money. And then You know, with homes, we have property taxes, right? We have homeowners insurance. You can be your own escrow. You can
Mhm.
pay out the property taxes out of your bank on yourself policy, pay out the homeowners insurance every year on an annual basis, and then pay yourself back monthly, for example, and then be able to recoup and hold that interest. So there's uninterrupted growth. You're not having to kind of interrupt your growth to pay for your property taxes, to pay for your maintenance on your home or your homeowner's insurance.
Right. Okay. So you guys can build wealth and invest in real estate at the same time. It doesn't have to be building wealth and doing real estate. No, it's all integrated here together. And the escrow account is great. I never really even thought of that because, if you want to keep your mortgage payments low and you're doing a mortgage that allows you to exclude the escrow account, typically you do need to put 20% down with most loans to do that, but that'll keep your mortgage payment really low. And then you can use the bank on yourself to pay your taxes and insurance, write a check from there, take a loan from there to do that, and then just pay that back. Like he was saying, it's going to give you a lot of financial flexibility, especially if you're self-employed, you're on commission, you're in sales, whatever it may be. Maybe you have income going up and down. This is going to be a great tool that you can use to help that ebb and flow. And the other thing I wanted to mention, you talked about down payment. So, this is mainstream enough that mortgage applications ask, do you have cash value life insurance? It's considered an absolutely normal asset to use for a down payment and to purchase real estate, cash value life insurance. So this isn't something that you need to hide or worry, like, will my lender accept this? Will my mortgage company allow me to use this? Absolutely, unequivocally, 100% of the loan programs that I know of and that I work on a daily basis allow cash value life insurance to be used not only as down payment in that, but also as an asset. For a lot of mortgage loans, you need to have assets in the bank, especially when you're buying multifamily investment properties, apartment buildings, that sort of thing. They want to see that you've got assets. Well, what are normal assets? Checking, savings, IRA, 401k. Okay, but what about whole life insurance? And some of the wealthiest clients I've had have huge amounts of money stored in these whole life insurance policies. If you have 100,000 cash value in your life insurance, we can list 100,000 in assets on your loan application. So this is not something that's like outside of the box where it's like you buried the money in your backyard or you have a safe with 100,000 in cash and nobody can really see it. This is a legitimate real asset that you can list on a loan application, and that will be, won't even be scrutinized. It's very easy to show that you've got this money available. And I know people get worried about that with this type of program, with this bank on yourself, or any type of whole life for that matter. It can be the same as having 100,000 in a bank account. Okay, that's how favorably it's looked at by banks because of, again, the wherewithal that it's had, the track record that it's had. They know money in a whole life policy is as good as money in cash in your bank account.
Mm-hmm. Right. I agree. Yeah. Okay. And this right here, Rob, is an actual client that we have. And sorry. This is an actual client that we have. And this client used to invest in, traditional or conventional investments like stocks and bonds and mutual funds. And you can see right here that like he had the, I'm sorry about this. Okay. He had the, the rise of the tech bubble, and then he had the dip. Just like how other people invest in the stock market, you have the ups and downs. So you kind of got sick and tired of having these ups and downs, and even though when you're down here, even though eventually you're going to go back up, you're still losing money, because time is money and you're wasting time by losing with these downfalls in the stock market. So he decided to open a bank on yourself policy and grow his wealth and have this as a core, as the foundation of his wealth. And he still took advantage of investments and stocks and stuff like that, but he used his own cash value from the bank on yourself policy. And what this allowed him to do is it allowed him to predict and to grow his wealth because his core was whole life insurance. He was always earning dividends and interest on his money as if he didn't touch his money. And he tripled his net worth in 10 years. Another thing that he did was, like, for example, do you remember that example we did with borrowing $50,000, using it for real estate? Let's say that it was a good investment. You put in $50,000 and like 6 months later you made $75,000, so a $25,000 profit. You can roll all that $75,000 back into the policy. 50 goes towards paying off the loan, and the extra 25,000 you could buy extra insurance, paid up insurance, and then earn interest and dividends on that extra money, and then keep recycling your money. So you're on the compound interest side. You're earning that compound interest on your gains that you're doing in your outside world and from the insurance company at the same time, you know, so it can get really powerful and really strong. And with this client, even if there's another huge recession, he's still going to be earning these. He's still going to be climbing, you know?
Absolutely. No, that's a huge benefit without a doubt. I mean, you know, you guys can see the illustration here of what's going on. You know, somebody's putting money in the stock market constantly. It's going up and down with the stock market. Then they simply take that money and redirect the same amount, I'm sure, that they were putting into these other investments and just put that into a bank on yourself or a properly structured whole life policy. And now every single year their investment value in that policy, their cash value, I should say, is going up. So maybe they do have stocks on the side and things. They don't have to worry whether they're going up or down because this is going up guaranteed. The other thing I wanted to mention is the fact that these are sustainable. So when you looked at that illustration he showed with 12,000 a year, and you may be looking at this and listening to us, and maybe you only make 30,000 or 40,000 or 50,000 at your job, and you're thinking there's no way I could afford something like that. Well, realize that you don't, first of all, that's just an arbitrary number. These can be customized to you. Maybe you could only put in 5,000 a year. There's ways to make that work. Maybe you could only put in 3,000 a year. I mean, whatever the amount is, they can customize these for your specific financial circumstance. But maybe on the other hand, your high net worth, maybe you want to put in 100,000 a year or 50,000 a year just in premiums. You can do that and make it happen. The cool thing that I've also been able to realize as part of this is it took me about 8 years of heavily overfunding my policies. And now I'm in a position where I have not made one premium payment myself in over 3 years on these policies. So what that means is I put in so much money that these are sustaining now. They're growing so quickly that they are not only paying the premiums now for me, but the cash value is growing. Okay, so I have a fully sustainable model. And for me now, the play is buy real estate, build wealth, retire. Okay, so I'm using this to allow this to continue to grow, much like the illustration you see on your screen where it's growing. Well, if it grows and grows and grows into 7-figure amounts, you can retire. You can take distributions. You can take loans against these policies. You don't even have to pay back. Again, we're getting a little bit maybe more in depth than what we wanted to cover on this podcast, on this episode here. But I want you guys just to give you a little bit of a teaser, whet your appetite a little bit about some of the other features of these policies, because if you set it up right and you're making money and you're funding this and you're being disciplined, this is something that you could literally work hard at and be disciplined for 8 to 10 years and structure this properly and never have to worry about money again. Never have to borrow money from a bank again. Never have to worry about what am I going to do in retirement. And by the way, you don't have to wait till you're 62. You could literally retire at 40 and take money out of these policies in loans and distributions. There's different specific ways to do it so it's done properly, as Sarry was talking about, with minimal to no taxation at all. So the growth is tax-free. And then when you take it out, if it's done correctly, you can also take distributions of that as loans completely tax-free because loan proceeds are not taxable. So again, it's just a huge benefit. It's absolutely, as I said, the cornerstone of where I'm at with my finances. And this is something I really wanted to open up to everyone listening because we haven't gotten into really advanced financial strategies and really talked about things that the multimillionaires and the very successful entrepreneurs use. This is one of those. If you don't already know about it, go look it up, read some books on it, get educated. And we'll give Sarry's contact info here in a second. But before we get to all that and wrap it up, I want, if there's anything, Sarry, that I have not touched on between what you've talked about in the case study or two and what I've talked about in my personal circumstance and my belief on this, are there any other benefits that are important that you think that the listeners and viewers should really know about when they're getting involved with Bank on Yourself, when they want a properly structured whole life? What else can they expect that's like just a huge win and different from other financial vehicles?
Yeah, definitely. You mentioned, this is what the wealthy are doing. This is what actually the banks are doing. About 80% of banks' tier 1 capital is in a whole life insurance policy because banks don't want that. They want that uninterrupted growth. They want those tax benefits. So instead of us going to banks for money, let's just do what banks are doing, right?
Absolutely. Yeah, I think that's called BOLI, BOLI, bank-owned life insurance.
Mhm.
So, I've done some research on that, and banks actually buy whole life insurance policies for their executives as like retirement strategies and exit strategies for their executives. So, banks are in the business of arbitrage, borrowing at a low rate and lending at a higher rate. They're using this as their cornerstone. Why can't you and I as consumers or investors or homeowners use this exact same strategy for ourselves? We can. That's what this is all about. Hopefully in the last 30 minutes, we've given you enough information to open your eyes up and have that paradigm shift to know that like this is something you probably want to look at. This is something you probably want to implement, even on a small level, into your personal financial circumstance. When I started, my first policy was $2,500 a year. Okay, $2,500 a year was my premium. Like I said, now I've built it up where I have several whole life policies that are properly structured like this, and the premiums are in the 5 figures. So, you can start slow, like I did, slowly but surely build up your confidence. And you can work with multiple mutual companies, as Sarry will talk about. These are companies that have been around for over a century and maybe even over 2 centuries. They've paid dividends every single year, even during the Great Depression. That's who I want my finances with. That's who I want managing my money, are companies that have been around for not decades, but centuries, that have a track record. Okay, that's who we're recommending that you use when you actually establish these policies. So again, hope everyone enjoyed this. I want to hand it over to Sarry. If people want to get in contact with you, if they want to get an analysis of their circumstance, how this can apply to them, Sarry's licensed, or excuse me, Sarry's licensed all over the country. He can assist you no matter where you're at in the U.S. So, Sarry, please go ahead and give them all your contact and how they can reach out.
Yeah, so you can go to finassetprotection.com. That's FIN, assetprotection.com. And then in there, you can send me an email or you can book an appointment directly with me. All my consultations are free. My analysis are free. So I do most of my business over the phone or over Zoom. So we could do it virtually. It's no problem. And again, it's FIN, assetprotection.com.
All right, guys, and you all know how to reach me. If you need anything in regards to your real estate or mortgage needs, please reach out. Hope it's been of value to you, and we'll talk to you soon. Take care.